I'm just making an update video for my stock market vlog, and so it's me, it's my account. So there's like a mistake. There's there's no mistake in the equity. It's just like there's a mistake in how they added up the numbers. So anyways, this is just an update, so I'll just tell you you guys like what is going on. So anyway, so gain loss still up 3,100, and so allocation, so I think there's a mistake in the bookkeeping. I think maybe there's like something wrong with like, I don't know. So anyways, so I put everything in HUT. So anyways, BT is still down 14%, and then WED is still down to 35%. FM is down 8%. Tilray is down 21%. So it's all normal. And so anyways, BTE it should rise in the long run, and then Bitfarm, so it's already back up. So the thing is, WED and Tilray are gonna be down in the long term, so I'm trying to exit out of them if they go for close to the break-even price, because I don't want to lose too much money. FM in the long run, it's gonna be around $11, and I'll show you guys how to do the calculation for like the target price for a stock and stuff like that. But anyway, so the main thing is that I put all my money into HUT. So HUT dropped down to like 9. So then I bought all this. So average price I bought for like $10 per share, and now it's way up. So that's up 32%. So that's up 8,000, and then obviously I did covered calls on HUT as well. So so here's where it's a little bit weird, because the calculation is wrong, because if I add everything up here, it should be wrong. So anyways, so ATD, this is a long option. This is long because like I want to, or basically I calculated what the target price of ATD should be, and then in the long run this should have a profit margin of around like 200% over 2 years. Then BT, so these are cover calls. There's nothing to worry about there. And then these are the long calls. So in the long run they're not worth this much. So if BT hits 450, then I'll try to exit out for like as little bit of a loss as possible. And then BB, so BlackBerry's not really worth much. So anyways, the main thing is obviously HUT, because so since the stock went up, then that means the calls also go up, and since I'm holding short position in the calls because they're covered calls, then it's a negative value. So that's what it is. So anyways, I'm going to calculate how much the actual loss is. Because it's definitely not 23,000. Because I can ignore this, because that's, you know, because those are covered calls, so I can wait until expiry. So then, it's just this. I don't know why it's so dark. 4, 5, 14, and then so BlackBerry. These are long positions, so I lose on this. I'm just gonna round, so like 500 plus 1,000 plus 1,000. Again, these are long positions. I mean short positions, so don't have to do anything about that. So then plus 300. These are all short positions, so I could just wait until expiry. So here, 600 plus 900 plus 300 plus 600. I just want a rough estimate. Plus 500 plus 100 plus 300 plus, I'll just round it up to 300. So total loss for this should be 6,400, not 23,000. So so let's see how I should do this. So anyway, so long option positions minus 6,400. And then so US stock, that is worth 35,200. Positive 35,200. And then Canadian stocks, so then this is worth 23,500. And then cash, so cash is 5,500. So then the net worth would be, let's see, minus 6,400 plus 35,200 plus 23,500 plus 500. 57. Okay, so that's how much it's actually worth. And if anyone wants to argue about this calculation, so this is the correct way, because this is the correct way to value it, because let's say because short positions are worth nothing at expiry. So because options are worth nothing at expiry, then I don't owe money on any short positions. So like, even though it's minus 19,000, I don't owe that, because at expiry it's 0. So that's how short positions work. And then, but the long positions, obviously, so let's say I wait until, let's say I take, like the ATD long call. So then on 16 January 26, so if so let's say, so I bought it for $689. So then if in January 2026 it expires, and let's say it expires out of the money, so then it's $0. So I do actually lose money. But for the short positions it's different. It's like the book cost is minus 6,250, but on expiry in January 2026 it's worth $0. So net I gain the $6,250, assuming I never sell before expiry, which I would never do, because obviously I would lose money if I sell before expiry. So that's how that works, if anybody is wondering about this. So it's effectively, so in the end it's about how much is it worth at expiry. So since stocks don't expire, you can use the instantaneous, like the market value right now. It's perfectly fine. You can use the market value for short positions, short option positions, but only if you actually plan on selling it before expiry, which I would never do, obviously, unless I make a profit, which I don't. So that's the thing about short positions, is that if the short position is profitable, you can buy it back for a profit. If it's not profitable, you can wait until expiry and then nothing, so you don't owe anything. So that's the idea, is basically lending out money and then you can borrow it. Well, lending something out and then you can buy it back. Well, I don't know, it's a short position, so it's like so anyways, it looks a bit scary, but like it's just in actual fact nothing's really happened. So anyways, it says like minus 19,000, but whatever, it's not actually true. It is true if I were to buy back my short positions for like a huge loss, which I would never do. So I just want to clarify that. That was the whole point of doing deep in the money covered calls, is that obviously if the stock goes up, the option goes up, so then it looks like I own, it looks like there's a huge loss, but that disappears at expiry. Anyways, I think I've explained this about like 10 different ways now. So basically there's two things that I want to explain. So I can log out now. So the first thing was obviously how to do the calculation for get an accurate calculation for short and long positions in options, if you're doing covered calls, which I am. And then the other one is the calculation for long calls. So at least this is what the calculation I'm using. So I'll just sort of explain that. Because obviously the web broker doesn't really know the difference between a short position and a long position, and what my strategy is. So like obviously if I try to exit out of my short positions right now, I take a $19,000 loss, but no reasonable person would do that. Only a robot would do that, because that doesn't make any sense. So anyway, I think I only have time to show the one calculation, so I'll do that. Okay, so here's how I calculate the net profit margin for ATD, which right now is the best. So obviously you have to calculate, you have to determine the strike price, the expiry and the strike price. So the best expiry is here, 2026, and the best strike price is $100. And the reason for that is because theta is lower the longer the expiry. So because theta decreases exponentially over time. So the longer the time, the lower the theta. So you want a low theta so that so that the time decay is low. And so everything in the end, it comes down to what so I'll just explain it with the numbers. So let's see. So this is for ATD Call 100. So this is 100 strike, and then expiry is January 2026. So annualized return. So that is the return per year. So then that is just 1 plus 1.22 to the power of 1 over 5, and then minus 1. So basically I take the 5 year. So I take the 5 year, and then I say that it's exponential, and then then I find the average. So it's assuming exponential growth, and then I take the average of those 5 years. So then 1 plus 1.22 to the power of 0.2 minus 1. So it should be 17%. So then the number of years, so that is straightforward. So that is just 700 divided by 365. 700 divided by 365. So that's 1.92. And then the expected return. So the expected return. So it's so annualized return is 17%, and then number of years is 1.92. So then it's over 1.92 years. So then what you do is 1 plus 0.17 to the power of 1.92 minus 1. So that is 1.17 to the power of 1.92 minus 1. So that should be 35%. So I expect the stock to increase in price by 35% from now until the expiry date. So that so then the price the target price. So this is the price that you expect. So the expected stock price. So right now it's at 82. So then that's 82 times 1 plus 0.35. So that is 82 times 1.35 is 110 points. So it should be worth $110.70. So strike price is 100. So then that means that the expected value of the call option at expiry should be $10 and is $110.70 minus 100, which is $10.70. So that is assuming that, you know, on the expiry date, the stock is worth $110.70, and then the strike price is $100. So then, since delta is equal to 1 at expiry, then it's just this. It's just the difference between the stock price and the strike price, which is $10.70. And then the profit margin, so the expected profit margin, I'll just say expected profit, is 1070 divided by how much is worth, how much I'm buying it for, which is $3.39 minus 1. So that is 1070 divided by 3.39 minus 1. So it's 216%. So basically, if the price is $3.39 and it's worth $10.70, then its value is over three times more than what it is selling for at market price. So then the profit is just 216%, because, you know, 3.16 minus 1 and then times 100%, so it's 216%. So that is the expected profit. So I don't know how long this video has gone on for, but I don't want to go on longer than half an hour. So I'm gonna end this video here, and then in my next video, like whenever I have time, I will either go into a deeper explanation of how to do calculations for long options, or I'll explain more about covered calls. But basically, right now the ATD call with the January 2026 expiry at $100 strike is the best that I can find right now. So I'm going to end this video here.